You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
Today feels decidedly risk-averse across global markets, really seeing a significant flight to safety.
Yeah, felt clear.
Oil prices slipping further, traders rushing into, safe haven currencies. The Japanese yen is a big one.
And this shift, it seems tied to the continued uncertainty around the U.S. government shutdown, but also, maybe more significantly, the Fed. Deepening divisions there about how tight policy really is.
Absolutely. We're going to break down those technical moves today, like why WTI crude has fallen below that key $60 level. And we'll look at the bearish outlook for U.S. equity futures heading into the New York session.
We should also touch on some key geopolitical things affecting trade flows, too. You've got warnings about potential contractions from the Panama Canal Authority, right?
Yeah.
And those escalating tech supply chain tensions, particularly between China and the Netherlands.
Yeah, lots to cover. Let's unpack it.
Okay, so starting with that main theme, this overwhelming risk-off mood.
Right. The U.S. dollar index, the DXY, it's sort of holding firm around 100, but, that strength feels circumstantial.
More about global fear than actual confidence in U.S. policy, maybe.
Exactly. That 100 level on the DXY, it's a huge psychological and technical support line, isn't it? It goes back to the summer.
Mm-hmm.
If it breaks substantially below that, you could see a really rapid shift in capital flows. But for now, it's acting like a fear buffer.
And what's really fascinating, I think, is the Japanese yen's behavior. It's sort of leading the charge among safety assets.
Yeah.
While the dollar is firm overall, the USD-JPY pair is actually stabilizing down in the 153s, pulling back from those recent multi-month highs.
Okay, but hold on. Yen strength feels a bit counterintuitive, doesn't it? Given Japan's, long-term economic fragility, is this massive diversification by foreign central banks, or is it just technical, maybe driven by that threat of intervention?
It feels overwhelmingly like the second one right now. We've heard repeated, pretty stern warnings from Japan's finance minister, against one-sided rapid moves in the FX markets.
Right.
And traders are reading those warnings as basically a near guarantee that officials will step in. They'll defend the currency if it weakens too much. So that fear of intervention, that's a real support underneath, not necessarily a genuine vote of confidence in the yen's fundamentals.
That makes sense. So it's policy-driven flow, not really economic. Okay,
Yeah.
So stepping away from the yen for a second, Europe looks pretty soft.
Yeah, the euro is struggling, kind of hovering near 1.15. It's weighed down by some downbeat European data manufacturing PMI specifically, and ongoing political uncertainty in France.
And the UK isn't exactly a picture of stability either. The pound weakened further, below 1.31.
What's driving that seems to be this increasing expectation of fiscal tightening. The opposition shadow chancellor, Rachel Reeves, she's been quite pointedly avoiding reaffirming previous tax cut promises.
And the market translation of that political nuance is really key, isn't it?
How so? Well, when the person who might be the next finance minister hints at higher future taxes, that makes UK government bonds gilts rally. They're outperforming because higher taxes are seen as deflationary.
Right.
And they reduce the government's borrowing needs. And that's exactly what we're seeing in the gilt market.
Which transitions us nicely to the central bank story,
Right.
because that's arguably the biggest source of domestic uncertainty for you in the U.S. right now. The Federal Reserve, well, it's showing deeper internal divisions than we've seen in quite some time. Makes forecasting policy incredibly difficult.
Yeah, there's a clear, almost paralyzing split emerging. On one side, you've got the doves arguing policy's already restrictive enough. They worry about breaking the economy too hard, maybe causing higher unemployment than their mandate allows.
And then on the other side, you have the hawks. They're still favoring that higher for longer stance. They argue underlying wage growth and non-core services inflation mean the job isn't done. Their fear is easing up too soon, only to watch inflation shoot back up, which would force them into a much harsher reaction down the line.
And that lack of consensus just paralyzes market expectations, doesn't it? Short-term interest rate futures are bouncing around like crazy because traders just don't know which side of the argument is winning day to day.
Exactly. It amps up the volatility. Traders are hanging on every single syllable from Fed members.
So what's key this week then?
Well, all eyes are locked on Fed Governor Bowman's upcoming comments and, crucially, the ISM services data. The market desperately needs clarity on which way that internal debate is leaning. Is the main path towards slowing things down, or are they still primarily worried about hitting that inflation target? That's why volatility remains so high.
Okay, so if the volatility is coming from central banks, The actual economic pain seems to be showing up pretty dramatically in physical markets. Let's switch gears to commodities because that technical break in crude oil.
Yeah.
Wow, it's perhaps the most bearish signal we've got this week.
Yeah, WTI crude dropping below $60 a barrel. That's not just noise, it's a massive technical break. Historically, $60 was a major psychological support level and a key swing low from late last year.
The breaking it probably triggered a lot of automatic selling.
Almost certainly, a
Good.
significant cascade of stop-loss orders from trend-following funds, likely confirming that bearish trend extension.
What's driving this really sharp drop, though, it feels like it goes beyond just typical inventory numbers.
Yeah, I think it boils down to pure, unadulterated global demand concerns. Just weak risk sentiment across global equities translating directly into fears of slowing consumption.
Yeah.
China, Europe, potentially the US too. That fear seems to be completely outweighing whatever messaging we're getting from the major producers.
And OPEC Plus seems to be struggling to control the narrative here.
Right, it seems so.
The news that they paused output increases for Q1. Apparently, at Russia's request, the market is interpreting that negatively. Instead of seeing supply discipline, traders seem to see it as OPEC basically admitting they lack confidence in near-term demand growth, regardless of their official sort of bullish statements.
That is the ultimate disconnect, isn't it? OPEC leadership is out there, arguing they see 1.3 million barrels per day of growth next year, dismissing any talk of an oil demand peak.
But the price action says otherwise.
Exactly. The market is looking at the output pause, the broken $60 price point, and it's just voting bearishly. And then, complicating the supply picture even further, you've got internal fractures. Libya is still reaffirming plans to boost its output towards 2 million barrels per day.
Right, so the supply side is fractured by internal politics, and the demand side looks fundamentally shaky. And this general commodity weakness, it extends beyond oil too.
Oh, yeah. Copper is also extending its declines, hit hard by soft construction and industrial expectations from both China and Germany.
Okay, and here's that key counterpoint we mentioned earlier about safety flows. Gold.
Right. Gold remained under pressure. It really failed to attract those typical safe haven inflows, despite the massive risk-off tone everywhere else.
Why is that, do you think?
Well, it appears defensive capital is strictly limited right now to instruments like the yen and U.S. treasuries. Things that offer either policy leverage, like the yen intervention threat, or actual yield security, like treasuries. Gold, being a zero-yield asset, it's simply failing to compete in this environment of high policy uncertainty and decent yields elsewhere.
That's a crucial insight. The safe haven basket is definitely shrinking. Okay, speaking of friction, let's try and tie this back into global trade flows, because the outlook for global commerce is arguably the grimmest signal we're seeing today.
Yeah, this raises a really important question about structural barriers to trade, things that go beyond just tariffs and politics. The Panama Canal Authority is actually warning that global trade volumes might contract in 2026.
Wow, 2026, that's a substantial long-term warning.
It is, and it's coming from a major global bottleneck, signaling that physical constraints, like water levels in this case, are now becoming real economic threats.
And we're seeing immediate, sort of tangible geopolitical friction right now impacting sensitive supply chains, too.
Like what?
Well, South Korea just announced expanded support for its exporters who've been hit by U.S. and EU steel tariffs. But maybe more pointed is the escalation in tech. China is vehemently criticizing the Dutch government for interfering in the chipmaker Nexperia's operations.
Right. That Dutch-China tech tension really underscores this broader geopolitical fragmentation. It risks splitting entire global supply chains. When governments start interfering directly in M&A or company operations based on national security concerns, it just injects massive regulatory risk into any investment decision.
And meanwhile, the wider geopolitical landscape remains pretty troubled across multiple areas, which only reinforces that desire for safety we talked about.
In the Middle East, for example, you still have ongoing reports of ceasefire violations in Gaza. That keeps regional tension high. While it's not currently impacting oil production directly, it keeps that volatility premium elevated.
And further east, the Russia-Ukraine conflict continues to impact industrial stability. Russia is claiming fresh strikes on energy and port infrastructure down in the Odessa region, directly hitting Black Sea trade and industrial output.
And even domestically within Russia, there was that blast at a petrochemical plant in Bashkortostan, caused a partial collapse. It just highlights the sort of pervasive internal stability concerns within their own industrial base.
And amidst all this global friction, you see the counter-alliance between China and Russia really emphasizing its continued alignment. President Xi met with the Russian Prime Minister, this Houston, pledging deeper cooperation in key emerging sectors, things like AI, green energy, trade, directly reinforcing their partnership as a sort of counterweight to Western pressure.
Okay, so if we pull all these threads together, we've got global political instability, deeply divided central banks, physical trade constraints starting to bite, and falling demand signals confirmed by that oil collapse. How does this translate directly to the equity markets as we head into the New York session?
Well, the translation looks decidedly negative. European indices are universally lower. The Stoxx 600 is down about 1.6%.
March.
And U.S. equity futures reflect that same bearish outlook. The tech-heavy NASDAQ is down, 1.3%, and the benchmark S&P 500 is down 1.1%. Selling pressure seems to be broadening out.
And what's fascinating there is the defensive flight within equities, right? You're seeing utilities and healthcare, those typical defensive sectors, they're outperforming the broader market, while basic resources and industrial goods are leading the losses.
What does that tell you?
It tells you the market is decisively pricing in a very slow, fragile, or maybe even potentially contracting economic outlook.
So the only real safe haven strengthening domestically seems to be U.S. Treasuries. They're firming up slightly due to this massive flight to quality, pulling capital away from equities, following the yen's lead. It's truly a risk-off environment dominating the flow.
Indeed. With volatility firmly established and those growth signals weakening globally, all attention really remains fixed on central bank commentary and any further developments from those major geopolitical choke points.
Okay, well, that wraps up our look at today's market action, really highlighting that drop in oil, the divided Fed, and the dominance of risk aversion leading flows into the yen and treasuries.
We really appreciate you tuning in and letting us help clarify some of these complex market narratives. Join us again soon on the Financial Source podcast.